Welcome back to the Patrick Lane Show, where we talk about personal finance, investing, and real estate. And today, my goodness, what happened over the weekend? It was a hedge fund crash and burn. They're going down like crazy, and it's just an amazing thing to see that somebody who has billions and billions and billions of dollars under management can crash and burn like that. So we'll talk about that in just a second. But before we do me a favor. Hit the smash the like button for me, hit the subscribe button, ring the little notification bell. We really appreciate your help in growing the channel. Now, over the weekend, on Friday, I actually started, guess what happened? Everybody who was trading started noticing all of these huge blocks of sales of certain stocks. And once everybody started digging into it, basically caused from a margin call on a hedge fund slash family office, and I'll explain what those are in just a second, called, nobody really knows how to pronounce it, but we're gonna call it Archegos. And this group, headed by a guy named Bill Huang, had billions and billions and billions of dollars under management. But the problem was that he was with Goldman Sachs, he was with Credit Suisse, he was with JP Morgan, he was with several other banks, and they all had all of this exposure. They were letting him trade, obviously acting as his brokerages. But the problem was that he had gone to the point where he was 500 to 700% margin, which is just absolutely crazy. So that means if he had $1 billion under management, that he was trading $5 to $7 billion in assets. And it's something that you and I can do in our retail trading accounts as well. We could trade on margin, but the problem is that when you get too far out, when you're too deep into margin, a margin is just a loan that your brokerage gives you in order to purchase more stocks. So, for example, if you and I have $100,000 in a brokerage account, they might give us 20 or 30% margin, so that we could actually, if we've got $100,000 in an account, we could actually have another $20,000 or $30,000 worth of buying power in our account. So we've got $100,000 worth of stocks, but we could potentially buy up to another $20,000 or $30,000 without depositing the actual cash in our account to cover it. It's a loan, basically, right? Your brokerage gives you a loan, you buy the stock with the loan money, and then at some point, you either hope that it goes up enough to cover the stock price goes up enough to cover the margin so that you don't have to pay it back, because remember, you're paying whatever the interest rate on the margin is to the brokerage, but you're hoping that the stocks that you purchase with the margin go up faster than and more than the margin loan rate. So for example, if you've got a margin rate of 3%, let's say, on your margin loan, but the stocks you're buying are going up at 10, 12, 15%, then sometimes that can work out for you because you're still making that 15% minus the 3% you're paying on the margin. But the problem is that in this case, this guy and this hedge fund in particular were not at 20 or 30% margin. They were at 500 to 700% margin, which is just crazy. So they've got, like I said, let's say they've got $1 billion in their account that they're managing. That means that they've got another $5 or $6 billion that they've borrowed and are investing that for those shares. So it's just a crazy thing that can happen when you get a bunch of large-scale investors, large hedge funds, and then you also have large brokerage banks like the Goldmans and the Credit Suisse and all these others, who are allowing them to go farther and farther out on the margin. Well, turns out that on Friday, and it was interesting that it was Goldman Sachs that actually decided, you know what, we're not going to do this any longer. This guy is way too far out on margin. We're hearing that he's got margin not just with us, but everybody around town. And so we're going to call the margin. Well, when they called it, he obviously didn't have the funds in there to pay back the margin loan. Just like if your bank calls you up and says, hey, that $20,000 that you borrowed from us, we need you to deposit it immediately, and you don't have the $20,000, guess what? They can take your stocks and sell them off to cover that liquidity deficit. And so that's exactly what happened on Friday to this hedge fund, Archegos. And I say hedge fund, but it is a family office. And a family office is a carve out from Dodd-Frank. Remember, Dodd-Frank is the bill that the legislation that keeps on giving. Dodd-Frank allowed family offices to not report anything. So typically a family office will manage the investment funds for one family or maybe a few families, depending on whether it's a single family or a multifamily. Apparently in this case, we're not really sure whether it is a single family or a multifamily office that he's running. And what happened was, instead of, most family offices will engage in sort of non-risky or the least risky investments, bonds, treasury bills, the old time long hold stocks, maybe some dividend stocks, those sorts of things. But in this case, this guy was treating Archegos and trading Archegos like it was a hedge fund. And so he was investing actively in high risk stocks. And that's why a lot of these stocks crashed on Friday, because when they had to sell them off, you're talking about $10.5 billion, $20 billion, $30 billion worth of stocks all hitting the market at the same time. That's absolutely going to result in a drop in the share price. And in fact, two of the biggest holders that Archegos had, two of the biggest positions, Viacom CBS and Discovery, dropped by 27% on Friday. And those are pretty good companies that you wouldn't expect to drop like that. But guess what? When the market gets flooded with $10 billion worth of shares all in one day, it's going to drop. The price is going to drop. And plus, everybody's going to step back and say, what in the world is going on here? And so that's what happened on Friday. Over the weekend, it's starting to snowball even more. And the question is, how much further into the market will this go? So Goldman was really the first one. They were the ones that were able to CYA and get themselves covered by liquidating the assets that they had of Archegos. So the problem is that the next investment broker in line is going to have more trouble trying to get themselves protected by selling off. Because once you flood the market with too many shares, then nobody wants them. The price keeps going down and down and down. Well, if you've got something that is on margin for $100 and you're trying to sell it, and you can only get $20 or $30 out of it, then you're in trouble because you're not covering your collateral on your margin loan. And that's what the banks were trying to do, was cover their collateral that they had put out there. So Goldman was able to do it. Credit Suisse is saying that they think that they've got significant impacts from this. Some of the Asian banks that he used are reporting that they're going to have billions in dollars of losses because of this guy. And so it's really something that's going to ripple through, and we still don't know yet if they have sold everything that they are going to offer for sale in order to cover. And so, just like Viacom, CBS, and Discovery dropped 27%, it could happen to other stocks. So just be wary out there of what's going on. And I think it is a learning lesson for those of us who are looking at other stocks. Think about the AMCs and the GMEs out there, right? We know that a lot of those hedge funds that were trading these are leveraged. They've got margin out there, and they've got to be careful, because if the stock runs too much and they don't have the money, they're going to get margin called, just like you or I would if we didn't have the money in our account. So that's what's happening. It's a lesson for all of us, but it's interesting that it is a lesson that hedge funds need to learn at this time right now. So do me a favor, let me know down below if you think that this is a broader impact on the market in itself as a whole. Do you think it's only going to impact these few stocks that are in this guy's holdings? Or do you think it's a lesson that hedge funds need to learn? And do you think it's something we need to be careful of? Do you trade on margin? What's the margin percentage that you have? Let me know in the comments down below. And do me a favor, if you received any education or entertainment out of this, smash the like button. I really appreciate it. And we'll see you in the next video.